Hey everybody, welcome to Finance Friday from the sunny yet cold Colorado here. And so actually in the Denver area this summer real estate lagged actually. So we were talking because this presents a risk to people that own property obviously in Denver area or in any market really that goes down, because median home prices fell as well as sales fell. So know all your risks when it comes to investing, not only in physical real estate, but we're going to talk different types of investments. So we'll talk REITs, we'll talk titling and trust and all this, the ins and outs about real estate, so you don't lose money, and most importantly, so you don't have this huge mistake that causes you a setback in your overall financial wealth. Okay, so in physical real estate, when you're buying a property, if you're going to finance, what I have seen all too often is people don't realize that if you put down less than 20%, even if you do 2 loans, you will have private mortgage insurance. So this is a quick one. I'll run through this really quick because this doesn't apply to everybody, but if you've ever had this situation, you know this is very important. When private mortgage insurance gets attached to your loan, it is there until you are able to refinance, when your equity then in the property covers more than 20% of the overall loan. Let me say that again. Let me say it a different way. So if you purchase a home, let's say it's $100,000. Let's just do nice even numbers. And you don't put down $20,000 because that's 20%. So if you finance, if you get a loan for more than $80,000, you will then have a monthly payment. Sometimes it's big. I mean, depending on the purchase of the home, every month tacked on to your mortgage. And unless you then refinance, if you refinance less than $80,000, then it'll go away. You have to have at least 20% in equity in the home. And this is something that people don't even realize it happens, especially sometimes you get like an 80-20 loan, you'll get 2 loans, and it gets tacked on to your loan. So I don't want you to have these payments. This can end up being thousands of dollars in, hey Ed, hey Brian, hi Johnny. Thanks for joining everybody. We're talking real estate and real estate mistakes and all different types of investments, because I don't want you to lose money and I don't want you to make an ultimate titling mistake, which is what I'm going to talk about next. So I got a question from a client recently about probate. Probate is the process that real estate has to go through, or that any physical property really, that your assets have to go through when someone passes away. Your assets have to go somewhere, right? So if you don't have a trust and you don't have a beneficiary, even on your accounts, even on your general investment accounts, your bank accounts, but in physical property, it's extra, I'll censor this, it's a big pain. We'll just say that. So it will go through probate, which is a court, and it can sometimes take years to settle, depending on, if somebody had a will, or if somebody didn't have a will, that's even worse. They're trying to figure out where the assets are meant to go. So when you put your real estate in a trust, this kind of avoids the whole probate process, because it tells the judge, it tells everybody where your asset is to go, whether it's split between 3 people or, to another beneficiary. Here's the caveat to that. So I had a situation recently with a client where the beneficiary in the trust had passed away, and it ended up in a divorce going to the divorced child's spouse. So I cannot stress to you how important this is, that if you have your properties or investments in a trust, that you keep that trust updated. Okay, this is super important. Don't wait until you're sick and about to be deemed incompetent. This doesn't help. Oh, that's cold. This doesn't help you. If you wait and then you put an extra to-do thing on your list when you are getting sick or you're terminally ill, or heaven forbid, this is not really what people want to hear, but just keep your trust updated to know where your assets are going. You do not want a piece of your real estate going outside of your family to a divorced ex-spouse, okay? So this is important, that you at least have a charity as a backup or something. Just get your documents in order, get your will updated, And if you're not sure where your trust says where it's going to go, then please consult somebody. Call an attorney, call your financial advisor, just consult a professional, okay? It's very important. So other assets, that's in addition to real estate, but other assets too. That happens with any real property. Probate is the process. So any metal coins, any jewelry, help me out, everybody. Yes, I love Ed Woolman. Love Ed Woolman. Thank you for the shout out. Yes, absolutely. That's in South Florida, although he can do work in several states. But yes, at Woolman, Gerke, and Solomon. He's a great one. Thanks, Ed. I actually wouldn't. Anyway, I wouldn't send to anybody else. He's great. He's the best in our area. So real property in probate is a tough thing, for your heirs to go through, and a trust can help you avoid that and just make sure your trusts are updated if you're going to do something like that. So covering real estate, all the mistakes in real estate. First, we mentioned private mortgage insurance. If you're not going to put at least 20% down, you're going to have this extra payment on your mortgage. Private mortgage insurance, it can be hundreds, it can be thousands, so you better check. Even if you get a dual loan, so if you get like an equity line and a regular conventional mortgage, you could have private mortgage insurance. Very important. Second thing is a trust, titling your real estate in your trust to avoid probate. So if you just have your property in your name and you pass away, it's going to probate. Make sure you either have it in a trust or you update, make it a joint with somebody. There's other ways to avoid that, but that's an easy way to get the property out of your estate. Thank you. So now, other investments that we talk about, and you guys can, email me if you have additional questions or if you want me to talk about any other type of, in the physical property asset class. But other asset classes, other ways to invest in real estate are REITs, real estate investment trusts. So if you have these, they can be really great. They can also be pretty detrimental to your overall financial situation if you do it wrong. So real estate investment trusts they can either be well, let me explain what they are first. First of all, they're a portfolio of real estate. So some real estate investment trusts will invest in commercial property, some are residential, some are even a specific sector, some are healthcare, financial, the list goes on. So you have to understand what exactly you're invested in. It's not just general real estate. Usually it's a portfolio of something in a specific niche. And traded real estate investment trusts are on the stock exchange. They trade just like a stock. What you need to know about that is sometimes they're taxed differently. There's a tax requirement. They have to pass through some of that income as return of principal. So sometimes you can get a tax advantage in investing in the REITs. The publicly traded ones that trade like a stock, and when I say that, I mean they trade all throughout the day. The price moves all day long. You also should know that a lot of times those were a non-traded REIT to begin with. So then when they went publicly traded, a lot of times they're around that $10 mark. It's very rare to see a REIT unless they do like a reverse split. A reverse split is when they increase the price and decrease the amount of shares they have outstanding. But it's rare to see a REIT like in the $200 mark, $100. It's going to stay lower, and they have to distribute their income. So when you're buying REITs, one of the bigger mistakes I see is people are buying a REIT that's meant for income, a higher dividend, for growth, and vice versa. They'll buy a growth REIT for income. So you have to, analyze a little bit. It's very easy nowadays to do research, obviously, and you get their registered investments. So you get a prospectus, you get not when you invest in the publicly traded market, but in the non-traded market, you get a booklet that explains to you all about your REIT and your real estate that you're invested in and their financials, and if they're geared more towards growth or income. This is all information that you can easily look up that you should know, because it goes towards your strategy, what you're trying to do and your goal. And when you invest in non-traded REITs, what I want you to know there is the liquidity. So liquidity is how quickly you can convert your investment to cash. And when you invest in the non-traded REIT space, there's benefits and there's there's risks. So the benefits are that they don't have that changing price all day long. It takes a lot of the volatility out of the price. So if you don't like volatility, if you're one of those people that doesn't like to see the ticking price every day, a non-traded REIT might be your thing. Now the price can still change, it's not fixed, but it just won't change every day, so you can kind of have this calmness. And when the price does change, a lot of times you get these big booklets, big updates on why the price changed. So non-traded REITs can be great, especially if you're looking to overall lower risk and lower volatility of your investment portfolio. The downfall to non-traded REITs, what you have to know is they are not easily liquid. So this is a long-term investment. By long-term, I mean at least 5 years. If you want to be able to access your money next week, if you want to get your cash next week, a non-traded REIT is not for you. You will take penalties, and actually they may even just flat out tell you no. They may do what they call a quarterly tender. If you've ever heard this term, or if you get these notices in the mail, you're invested in a REIT somewhere. There's quarterly tenders, which means you can cash in a part of your REIT every quarter. So if you submit, let's say they go on calendar quarters, if you submit in January that you want, half the money out of your REIT, you're not getting it till the end of March if they do a quarterly tender. Yes, that's correct. You may not get it for 2 months, which is normal. You just have to know these things ahead of time. It's not necessarily a negative. It's just something that you kind of have to be aware of when you're looking for an investment. You don't want to invest in something that you think you can just get the money out when you want it, and you can't, so you don't put a ton of your money. You never go putting half of your money in a non-traded REIT. Stick to like 10% of your liquid net worth. And they can pay great dividends. Sometimes they're 5, 6, 7%. They can be great income. And when you reinvest the dividends, some of them offer an incentive, which means they'll give you a discount on the price when you reinvest dividends, which is awesome, because then when the price appreciates, you get a huge gain on that. You bought at a lower price. So you want to make sure. We're talking, for those of people that join, we're talking real estate mistakes and what not to do when you're investing in real estate. And there's different ways to invest in real estate, right? It's not just going out and buying a physical property. People invest in real estate investment trusts. They buy exchange traded funds or index funds or mutual funds that are invested in real estate that may own REITs. So what you own then in that scenario is, in an index fund, you may own some REITs within that index fund. So you may own thousands of properties within that fund. So that's going to also iron out the volatility. And if that's not what you want, if you want more of a focused growth strategy, then maybe you look elsewhere. You don't want things in your investment portfolio that don't align with what you're trying to do. And that's a big mistake that I see when people invest in real estate. They're going for growth and they're invested in something that's for income. And over time, that will eat away into your performance. So you can't expect growth performance if you're invested in income generating investments. It just doesn't work that way. You can't have it both ways. So I urge you to reach out to us if you have additional questions in real estate, but look over your portfolio, see what you own, see if you own a REIT or if you're a real estate investment trust, and in your physical property, double check your titling. Just make sure that everything is titled all right, because we talked about really 3 to 4-ish, things that you shouldn't do when you're investing in real estate. And one is, if you buy a property for, if you put less than 20% down, you're going to have an extra payment of private mortgage. Sorry, I just had a phone call coming through. Sorry for that. And, avoiding that can save you thousands, on top of when you invest in real estate, when you title it. If you turn it into a trust, just keep your trust updated to make sure it doesn't go through probate and it makes your family struggle and all this, and plus, not to mention, if your estate is subject to estate taxes, which is over the $5.5 million for a single person, $11 million for a couple, which is a pretty higher amount. But you want to make sure that your trust, and your insurances help you pay with those estate taxes. So that's a whole nother live. I'm getting off on tangent here, but go ahead and reach out to us. Check out our website, novawealthmanagement.com. I'll post these tips on my Twitter page, and I'll probably do a summary YouTube video. Check out our YouTube channel and follow me on Twitter at NovakovicAmy. And we also have our corporate Twitter, which is at Nova Wealth Management, management abbreviated MGMT. So thank you for joining. If you have any questions, reach out to me. Hope you guys have an awesome weekend. Thank you.